Good morning and welcome to Killik & Co.'s podcast for the 7th of August 2015. First of all, this week we'll be talking about some of the macro data that's been out during the week. Then we'll touch on some of the new stocks that we're covering, as well as some of the stocks that have reported results this week. And finally, just look at some of the covered stocks that are reporting next week. So starting off in the UK, this week saw an MPC meeting as well as the release of the quarterly inflation report. Interest rates were unchanged at the meeting, with one member voting for an interest rate rise. This was a surprise to the market, which had expected two members to vote for an interest rate rise. In addition, there was a reduction in the near-term inflation forecasts from 0.6% to 0.3%. And this more dovish tone has resulted in market expectations of an interest rate shifting out. And that can be seen in this chart here, where you can see the drop in the expectations of interest rates as of December. So it was at 0.75, implying a 25 basis point rise, and now it's dropped down towards below the 0.7 level. Moving on to the US, the focus in the US this week will be on the payroll data that's due to be released today, as well as the unemployment rate data. So there were mixed numbers in PMI surveys this week, as well as weaker than expected ADP employment data. And as a result, the market is expecting a slight increase in the number of payrolls this week, as well as a flat unemployment rate at 5.3%. Average hourly earnings will also be closely watched this week, and there the market is expecting a 2.3% year-on-year increase. On this graph here, we can see how the unemployment rate in the US has steadily trended down since the global financial crisis. Moving on to the Eurozone, the data there has generally been quite strong. Regional PMIs were ahead of forecast, with a good performance coming out of Spain and Italy. In Italy, manufacturing activity hit a 51-month high. Unemployment also fell by more than expected in Spain, and Germany factory orders have been strong. There has been some data that has disappointed. So Eurozone retail sales fell 0.6% in June, and there was also an unexpected fall in German industrial production today, which has driven European stocks lower today. Moving on to some of the stock side, this week we initiated coverage of Western Digital. Now, Western Digital is one of the leading producers of hard drives for computing systems. It enjoys a duopoly together with Seagate, having 85% of the market between the two of them. The reason why we like the stock is we believe that there will be a significant growth in the amount of data being stored over the next 5 to 10 years. This will be driven by trends such as mobile computing, cloud computing, big data, as well as advances in the amount of data needed in areas such as healthcare. And here you can see estimates for the strong growth in data. At 2014, growing up to the end of this decade, it's around a 6 to 7 times increase in the amount of data storage needed. Moving on to companies that have reported this week. So Church & Dwight is a US-based household goods and personal goods company that we have a buy recommendation on. It's reported better than expected results this week. Good performance on volumes, as well as good cost control, and this means it should have good earnings numbers for the full year. And one of the reasons we like the stock is that it has an exceptionally strong track record of returning cash to shareholders, having paid a dividend out for the past 114 years. Duerr also reported this week. It's a German manufacturer of industrial automation and robotics products. Its main market is into the auto manufacturers, where it produces products for the paint shops, including painting robots, as well as large production lines that dip the bodies of cars into anti-corrosive solutions. It reported good results, and although the stock has sold off since May on concerns over what's happening in China, it did report very strong orders coming out of China, and management did confirm that post the end of the first half, they haven't really seen any change in the level of orders. Slightly more disappointing was Disney's results this week. Although they beat earnings expectations, revenues were below expectations, and that was partly driven by poorer than expected performance out of their international parks operations as well as their interactive division. But what has been more of a driver of the fall off in price that we've seen here was the fact that they reported some weakness in subscriber numbers in their ESPN operations. ESPN is the leading sports channel in the US, and that's sold through other pay TV operators. And what's starting to happen is there does seem to be some impact from the effect of services such as Netflix, where customers are doing what's referred to as cutting the cord, in other words, no longer taking pay TV packages, and this has had some impact on ESPN subscriber numbers. However, we don't believe that this is a significant risk. We believe that sports is the one area where customers will continue to pay for live coverage, and ESPN is the strongest sports network in the US, and so we believe Disney remains having a very strong position in this area, as well as a very strong position in all the content creation assets that it has. Moving on to the week ahead, the stock that we're going to look at this week is Prudential. Prudential reports results next week. This has been our favourite UK insurer for quite a while now, and the reason we like this is its very strong position in Asia, where insurance penetration remains very low, and also there isn't much in the way of state safety nets, which means that people have to provide more for their own protection and health needs. And if you look at the potential that exists in Asia, this graph illustrates the level of life insurance premiums per capita. So the US is over here, and Singapore, which is obviously a very well-developed Asian market, is at the same sort of level as the US. But if you look at other Asian countries, Malaysia, Thailand, Indonesia, Philippines, you can see the potential that exists for insurance premiums to increase dramatically towards the US level or Singapore level. Another reason we like Prudential is that its US and UK operations are also well placed to benefit from the increased need for people to provide for their retirement needs themselves as state retirement benefits become less valuable. That's all this week from us. Thank you very much for watching, and we'll see you again next week.